2.6%. But if you look at the IMF forecast, it broadly reflects the fact that oil prices have been favorable. There has been foreign exchange liquidity, so the relatively stable foreign exchange market. Basically around oil and oil production as well as rising prices. But for us, we believe that looking at Q4 2017 numbers, we saw a broad-based expansion across all the sectors, so for both oil and non-oil, and we're expecting that in 2018 we'll still see that kind of expansion in for Q1 as well as full year 2018. So we are more optimistic. We believe that in 2018 we would grow 2.6% by the end of 2018.
That's the forecast at Afrinvest, where you are one of the investment analysts.
Yes.
You believe that even with the IMF at 2.1, we can do 2.6.
We can do 2.6 because if you look at non-oil sector last year, we had the agri sector, we had the services do better than we had expected. So on this backdrop, we're saying in 2018, with the all of the indicators that we've seen, the foreign exchange is still, the market is still very stable. Inflation is moderating. So all of this will feed into increasing consumer spending as well as which will have a broader effect on the economy. So
is there a reason? The finance minister and the central bank chief yesterday briefing Nigerian media in Washington says, look, we're on track. The journalists were asking questions whether we are still on that trajectory, and they said, yes, we're on that trajectory for that growth for this year. But do you see any fault line between now and the end of the year for this 2.6 projection from Afrinvest and 2.1% from the IMF?
Well, we can say that there's still some structural issues that might still, taper or moderate this our forecast. One of which is the problems or the issues we're still having in the power sector, which could invariably affect the manufacturing sector and all of those sectors that depend heavily on electricity. We're also looking at the issues that are still around port congestion and all of these things that feed into the non-oil sector. So once we're having those issues, it might, depending on the movement, if things are not put in place as at when due, it means that this would, invariably affect our forecast. But when we look at it on the balance of play, with the elections coming up and we're expecting to see more spending, in H2, we believe this will kind of like abate and, and balance it up and see more private spending, and then outputs will ultimately grow.
Is there something in all this story, what you call the macro story, for anyone who's trading the market?
Well, I would like to basically look at the equities market. Fundamentally, once the macroeconomy is doing well and oil prices are, favorable, it means that you see more of interest in the equity market, and looking at the fixed income market, the more yield moderation, it means we'll still see sort of positive sentiment in the equities market, and we expect this to feed largely, on the bottom line of the companies, that are listed on the exchange, and therefore see more positive sentiment in the equities market, basically.
How much of this growth story do you think the equities market will be able to play? If you look at the year so far, we're almost finishing April, and it looks like it's been on a downward trajectory. Year to date, we're not looking so fantastically sweet. 6.72% year to date. Month to date, a negative 1.66%. So the month of April, largely like March, and a little bit also like February. So we're looking at 3 months back to back in which the broader market, the NSE broader index, has been largely lackluster. Now the numbers for Q1, some folks say maybe the Q1 will lift us. You've seen GTB, you've seen Zenith now. Yeah. We have a Stanbic and BTC on the street, and you see there are non-performing loans been an issue here, even though some of them are having some write-down. There are issues with the FX, with the fixed income market as to where yields is also heading. So do you think it's going to be a major rally? Last year we did north of 42%.
That's 2.3%.
We're not getting that again. Nothing good happened twice.
Well,
maybe.
Well, you can't particularly say so. When I look at January 2017 versus March and then April, we look at there was a bullish run in the beginning and the start of the year. We've seen the positive sentiment from 2017, but I believe that rally, a lot of investors priced in a lot of expectations of the full year 2017 result. So when we are expecting maybe more bullish run when the results were released, we saw investors were taking their profit because they had priced, dividend and impressive results. So it was somewhat like a market correction, and I think that's fine. But on 6.7%, we're still fine, and we can still get better. With Q1 2018 results coming up, I expect this to buoy sentiment. If you look at market breadth that shows investor sentiment, it was positive and even did greater than the week before. So that means we're still seeing more activity in that space, and we're optimistic, we're positive that
who's leading this? Who's leading this? Who's leading us as we speak? Some folks are foreign investors are holding, they zipped up their purse, as it were. It's only foreign or local investors that are major players right now in equities.
Well, yes, we're seeing more domestic investors come into the market, but the foreign investor participation has moderated, but not drastically.
Not totally out.
Yes, not totally out. So there's still a balance of pair, and I think it's good that domestic investors are coming into the markets as well. And obviously it helps to kind of moderate what you say. The foreign investors are driving our market, so at least we'll have more domestic people in the markets, and I think that's good for the market, to be honest.
So how long do you think? Twist that. Do you think the local investors who are basically you and I, and the other man in the street, are interested in other macro stories that hasn't really fit into the box, which is one, the budget?
Yeah. Well, I would say when we look at the budget and its implications for all of the other parts of the economy.
Do investors, local investors, really care about the budget? Do they really care?
Some, yeah, quite a number. Most of the domestic investors are knowledgeable, so we can't rule that fact out, actually. So we have most of the institutional investors play in that space, and obviously they look out for all of these indicators and how the passing of the budget would ultimately affect the economy. So yes.
Or the delay of the budget. Well, no. Let me play the devil's advocate. You want to say, well, the passage of the budget. Now, if it is also delayed, I think it somehow is going to feed into the corporate numbers as well. Somehow,
yeah, exactly.
One way or the other. Somehow.
Yeah, if you look at what the passage and the delay of the budget does to the broader economy, if we look at what are the implications, says what does it have on investor and business confidence? And when the budget is passed earlier in the year, it kind of gives a direction as to where where the spending, what activities will go on during the year.
Omoefe.
Yes.
Perhaps we're used to this delay. Maybe. Just hold on your thoughts. Let's discuss this some other day. We got to let you go. But somehow, I think maybe we've gotten attuned to this delay in the budget passage, and the corporates will have learned how to move on.
Well, you can say that.
Maybe. Just maybe. Thank you. Have the first handshake on the program for the week. Thank you very much.
Thank you
Investment analyst, one of the great team at Afrinvest Securities. Let's continue the conversation on the Nigeria on the road. We were at the Commonwealth Business Forum, then we were at the World Bank, IMF meetings as well. So what's the takeaways? What did we bring back from these two meetings? I'm here at home. I'm going to be asking someone, what does he think we've made out of these two meetings? We're going to start from the Commonwealth Business meetings in London.